Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Ana Cruz, mortgage broker in Burlington, Ontario.
If you're self-employed in Burlington and your accountant has done a great job keeping your tax bill low, what if that same great job is the reason a lender just told you no?
That tension is real, and it trips up a lot of borrowers who are genuinely in a strong financial position.
Let's start with a scenario that Ana Cruz sees regularly in her self-employed mortgage solutions practice.
A sole proprietor in the trades, 4 years in business, strong revenue, legitimate deductions across the board, walks into a lender with 2 years of tax returns.
And the net income on those returns produces a qualifying amount that's nowhere near the purchase price they're targeting.
So the lender declines, and the borrower walks away thinking the answer is no.
But Ana Cruz's whole practice is built on the idea that a decline from one lender under one program is not a final answer.
It's a documentation problem, not a creditworthiness problem. That distinction is where the work begins.
So let's talk about why the standard process fails this borrower in the first place, because it's not personal, it's structural.
The standard underwriting model was built around T4 income, a fixed, employer-verified number that a lender can use with confidence.
When that number doesn't exist, the whole framework has to work differently, and most lenders aren't set up to do that well.
For a self-employed borrower, lenders use the net income reported on the T1 General and the T2125 business statement. That's what's left after every eligible deduction has been applied.
And if you've written off a home office, vehicle use, software subscriptions, professional development, all legitimate, that net income can be significantly lower than what you actually brought in.
Research consistently shows self-employed Canadians report net incomes 20 to 40% lower than their actual cash earnings after deductions. That gap is the core issue.
And the stress test doesn't help. It applies to self-employed borrowers exactly the same way it applies to everyone else.
The stress test itself isn't the variable, the qualifying income figure is. If that number is suppressed by write-offs, the maximum mortgage comes down proportionally.
So the system isn't broken, exactly. It's just designed for a different kind of borrower. And that's where Ana Cruz's approach to self-employed mortgage solutions in Burlington becomes genuinely important.
What Ana Cruz does differently is that the file gets structured before it ever goes to a lender. The income analysis happens first.
Not at the application stage, before that. Before a lender sees anything.
That matters because Canada's mortgage market isn't one thing. There are federally regulated lenders, provincially regulated lenders, credit unions, private lenders, each with different underwriting guidelines.
A file that doesn't qualify under one set of rules may qualify under another. But only if it's presented correctly for that specific program.
And that's where knowing which documentation pathway fits the file is the actual skill.
Walk us through what those pathways look like, because I think a lot of borrowers don't know these options exist.
The first is traditional tax return underwriting, T1 General for 2 years, T2125 for 2 years, notices of assessment confirming the returns were filed and accepted. If you're incorporated, add the T2 corporate return and accountant-prepared financial statements.
That's the standard path, but if the net income on those returns is too low to qualify, there are alternatives.
Alternative doc programs, sometimes called bank statement programs, allow lenders to use business bank statements instead of tax returns to calculate qualifying income. The average monthly deposits become a proxy for income.
So the write-offs that reduced your tax bill don't necessarily reduce your qualifying income under that program.
Exactly. Some lenders also allow add-backs for certain non-cash deductions like depreciation, which can increase the income figure they'll accept.
And the right path depends on the specifics. How long the business has been operating, what the deduction profile looks like, what the down payment is, what the property type is.
Ana Cruz is clear that the answer isn't always to reduce your deductions. That's a conversation for your accountant. What a broker can do is take the income picture as it exists and find the lender and program where that picture works.
That framing matters. It's not about changing your financial behavior. It's about finding the right fit for the file you actually have.
And the Burlington and Hamilton market adds another layer of complexity here, because benchmark home prices in this corridor are well above the national average.
Which means qualifying income thresholds matter more here than in lower-cost markets. The absolute dollar amounts are higher, so the gap between what you report and what you need to qualify is more consequential.
Ana Cruz's work in self-employed mortgage solutions is specifically grounded in this market. Lender appetite, turnaround times, underwriting flexibility, those variables shift, and local experience with them is genuinely useful when a file has complexity.
Let's go back to that trade's borrower we opened with. What does the process actually look like when Ana Cruz takes that file?
The first step is a full income analysis, not just the tax returns, but the business bank statements, the deduction profile, the 2-year income trend.
Because lenders look for consistency. Is the income stable year over year? Is the business growing, holding steady, or declining?
A 2-year average that masks a significant drop in year 2 raises questions. A file where year 1 was low and year 2 was substantially higher might allow for a more favorable calculation depending on the lender's guidelines.
These nuances determine which lender is the right fit. It's not one size fits all.
In the scenario we described, if the bank statement calculation produces a qualifying income that supports the purchase, the file moves to lenders who offer that program. Down payment, credit profile, and property type all factor into which lenders are viable.
And the outcome isn't guaranteed. Ana Cruz is clear about that. Every file is different, and the specific numbers determine what's possible.
But a decline under one program is not a final answer. There are often multiple pathways worth examining, and the right one depends on a thorough review of the full financial picture.
There's also a practical point about documentation that Ana Cruz emphasizes: gathering everything before you approach a lender, not scrambling to produce it mid-application.
A well-prepared self-employed mortgage file does the explaining before anyone has to ask. Income summary, 2-year tax history, business profile, a narrative that connects the numbers to the actual business.
When a lender receives a file like that, the review is faster and the questions are fewer. That's not a small thing. It's often the difference between an approval and a stall.
And the 2-year self-employment history threshold is worth flagging. Most lenders want to see at least 2 years of consistent self-employment before they'll consider a file under standard programs.
So if you're approaching that mark, Ana Cruz's advice is to have the planning conversation before you start the purchase process, so you know exactly where you stand.
The strategic planning piece is also bigger than just the approval. Ana Cruz frames self-employed mortgage solutions as a structure conversation, not just a rate conversation.
A 5-year fixed term offers payment certainty. A shorter term with the option to refinance is a different structure with different trade-offs. Which one fits depends on how income is reported, how the business is growing, what the next 5 years might look like.
Prepayment privileges matter too. A self-employed borrower whose income fluctuates may benefit significantly from a mortgage with generous prepayment options in strong revenue years.
These are details that don't show up in a rate comparison but carry real financial consequences over the life of the mortgage.
And for incorporated borrowers, how income is drawn from the corporation is a topic for an accountant, but what Ana Cruz can do is communicate clearly what lenders need to see and make sure the file reflects the income that actually exists.
So what does the outcome look like when this process works the way it's supposed to?
The borrower who was declined under standard underwriting closes on the home. The number that looked like a barrier stops being one.
Not because anything was misrepresented, because the right documentation pathway was used, and the file was placed with the right lender for that specific situation.
That's the core of what Ana Cruz does in her self-employed mortgage solutions practice in Burlington. The decline wasn't the end of the story. It was a signal that the wrong program was used.
And I think the broader truth here is this. For self-employed borrowers, the mortgage process requires a different kind of preparation, and the preparation has to happen before the application, not during it.
If you're self-employed in Burlington and you've been told no, or you're worried about what your tax returns are going to show a lender, that's exactly the conversation to have before anything else.
Ana Cruz is a mortgage broker in Burlington specializing in self-employed mortgage solutions.